Greetings, test takers. This is Dean Tenney. I'm coming to you from my studio here in fabulous Las Vegas. Today, we're going to do Score More 44. On your Series 7, you get about 20 plus option questions. We're going to do 44 and explicate them. These comes courtesy of a collaboration we have with TestGeek Exam Prep LLC and its managing member, Brian Lee. As part of that collaboration, not only do we get to do this explication, but our viewers and subscribers get 20% off on his paid supplements. My channel is a free supplement. TestGeek Exam Prep is a paid supplement. And at TestGeek Exam Prep LLC, there's a link on my homepage. There's also a link to the YouTube channel on the homepage if you want to check out some sample videos or go to the website, see what kind of paid supplements are available. You can certainly do so. I'll also put that in the description, link in the description to both of those. And I'll put a link in a pinned comment so you can find that pretty readily. In the community playlist, you can find a 5-minute video on that collaboration. So the carve out that TestGeek Exam Prep LLC offers just for options is all Brian's videos. He's got some of the top videos on YouTube in terms of Series 7 exam search. You get all those and you get this exam we're about to do, and you get the answer key and rationale. With our 20% discount, that's $40. With our $39.95. With the 20% discount, which is Guru20, that is the 20% discount code, that brings it down to 32. But by far the best deal is the 20% off on his full supplement, which would include everything on options, everything on the Series 7. That's $99.95. With the 20% discount, that's $80 for all Brian's Series 7 paid supplement, all his hours of videos, his Series 7 quick notes, class notes, study notes, whatever you want to call those, Series 7 practice exam answer key, and what we're about to do presently. All right, so remember, you can always stop, attempt the question yourself, see how you do in terms of doing these. So that'd be a good check for you to see where you're at in terms of intellectual ownership of options. And I'm going to set my little egg timer for 30 minutes because 30 minutes is about where people, sustain concentration. I don't know what this will come in, 44 questions. Test, we get about a minute and a half, but I'm going to be talking about them. So you can always stop, pause, and come back to it later. All right, let's get started on Score More 44. Okay, so if a customer buys one FLB October 50 call at 3, and she exercises the option to buy 100 shares when the market price is 60, what is the cost base of the stock? For the most part, break even and cost base follow. What I mean by that is cost base more often than not follows from break even. I personally, what Dean wants to do is not testable. But what I like to do things on a per share basis. And I like to use dollars out versus dollars in. And so in this question, this customer, she paid $300. Let me get a smaller font here. She paid $300 for the option. Now, Dean would have done that as 3 points, but, however you want to do it. And she exercised the options. That means she paid $5,000 for the stock. And that means the break even is going to be $5,300, or excuse me, cost base is $5,300. So again, what you want to do is see what kind of mechanics. So lots of ways to do questions. I like to use a T. I think Brian uses a T, track money in and out. If you get good at contract specifications, you're not fumbling around that buying an FLB October 50 call at 3 means you get to buy the stock at the strike price, you can track money, you're in pretty good shape. This answer set is so important. Number 2, this answer set is so important that I'm thinking about making an entire video just on opening and closing transactions. One thing you want to be looking for is confirmation. So, if you see an answer set more than once, and the content I provide, the content TestGeek Exam Prep LLC provides, STC, Kaplan, Solomon, Past Perfect, it's on the test. And so you should be comfortable with every one of these in terms of what's going on. So you should know that choice A, before we even look at the question, You should know that choice A is what we use to establish or add to a short position. You should know B is what we use to establish or add to a long position. It says investor owning the contract. So that means this customer already did an opening purchase, dollars up. Before you even look at the question, you should know a closing purchase is what we use to eliminate or reduce a short position. A closing sale, ding, 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 ding. A closing sale is what we use to eliminate or reduce. What I mean by reduce is if I have 10 contracts, I can sell 5. And so the answer to that question is going to be D. And that is very much, let me get out a highlighter here so I can highlight things. When a new option customer is returned, when must a new customer return a signed option agreement? That sequence is very, very testable. The whole sequence. So what happens first is I give you the disclosure document, the characteristics and risks of options, 100+ pages on all the bad things that can happen to you. You know, there are no good news in this thing. You can't possibly read this while I wait. So now I'm going to go back to my registered option principal and see if I can get your account approved. He says, have you given him the OCC disclosure document? I said, I have. You know, have you done any trades yet? I better say no. Because, okay, I'm approving him for whatever level of approval we get. I call you back. I go, wonderful news. You have been approved. We can now do our first trade, our first opening transaction, So the opening transaction comes after account approval. From account approval, we have 15 days. That is very much a test question to get back from you the option agreement that you've read and you understood that document. And if you have any questions, please let us know. Now, very testable to know that if that doesn't come back to us within 15 days, you're only going to be allowed to do closing transactions. So the answer to 3 is A. Which of the following investors are bearish? I highly recommend, listen, I don't know how much I should gripe about people on the channel. But it is kind of frustrating sometimes when people are doing these practice questions without having laid the base knowledge first, not done the lectures or read their book and done the stuff they're supposed to do. You shouldn't be jumping into questions right away. This is 44 questions I'm going to put this both in the options playlist and the practice exam question playlist. And this will bring the total practice exam and practice question count to over 600 practice questions on the channel, which I think is pretty good for a free supplement on Series 7. Anyways, that being said, before you're messing around in the exam playlist, maybe you should be doing the lectures. And if you join me for a lecture, we would go over the matrix. There are 2 types of contracts, calls and puts. You either buy them or sell them. And so that means we have 4 basic option positions. And when we buy a call, we have a choice to buy the stock. I wouldn't want to buy the stock unless I thought the stock was going up. And when I write a put, I have an obligation to buy the stock. Both of those transactions are, oh man, look at that. Dean made a mistake here. I didn't read. It says bearish. So let's get out a different color. And by the way, I would be prepared for both of this. This question is the bearish or sell side. We don't mean the option. We mean selling the stock. And the other question that Dean was answering that wasn't here is the bullish or buy side. So if it had asked what is the bullish or buy side of the options market, Dean would have been correct. But since that's not what Brian asked here, it's going to be the writer of the call. Might have an obligation to sell the stock and the buyer of a put. And so the answer is going to be 2 and 3 is going to be the appropriate answer there. So boy, Dean ought to follow my own lessons here. RTFQ, read the question, right? Don't answer the question you thought was there. Answer the question you're being asked. So the answer to question number 4 is D. And by the way, I'd also know that the writer of the call, the naked call, has unlimited risk. And then if it had said bullish or buy side, then the answer would have been B. I'd be prepared for either one of those. So be prepared for either one of those. All the following would affect an option premium, except all the following would accept an option premium. The price of the underlying security, absolutely, right? Because the price of the underlying security, the underlying interest, determines whether the strike price of the contract we're looking at is in the money, at the money, or out of the money. So most certainly A certainly does. B, the volatility underlying security, absolutely. You know, again, this is not a lecture, but all speculative option strategies boil down to you're either buying volatility or you're selling volatility. You know, you're either buying in a long call, for example, you're buying upward volatility. In a long put, you're buying downward volatility. In a short call, you're selling upward volatility. And in a short put, you're selling downward volatility. You're either buying or selling volatility. And that certainly has something to do with the premium. You know, if I'm going to agree to be a potential victim and short the option, it's a stock that has a high beta, it is highly, you know, has a high correlation, more volatile than the underlying market. That's going to have something to do with the premiums. Volatile stocks, options on volatile stocks have greater premiums. The number of contracts that you're long or short. No, that has nothing to do with it. Whether you buy 2 of them or 3 of them or 5 of them, that has nothing to do with it. The time of expiration, absolutely. You should definitely know that longer term option contracts always have greater premiums. So that's a important enough for us to make a note here. So something you need to be aware of is that lower strike call contracts always have greater premiums. Regardless of the market price, lower strike call contracts are always going to have greater premiums. A choice to buy at a lower strike is always going to be more desirable. People who sell them know that, they charge accordingly. You should definitely know that higher strike put contracts always have greater premiums. And then this one, you should definitely know that longer term option contracts always have greater premiums. Again, a higher strike, a choice to sell at a higher strike, choice to sell at a higher price is more desirable. People who sell them know that, charge accordingly. If you're going to want to have a choice to sell at a higher strike, you're going to pay more. And the longer you want me to be a potential victim, I'm doing it from the short perspective, but you should be able to do it either way. Longer term option contracts, always have greater premiums, because the longer I give you to be right, the greater chance it is, you're going to be right. To be right as a buyer of an option, you got to be right about 3 things. You got to be right about direction, how far, and timing. And so timing is going to have something to do with the premium. So the answer to that one is C. C. To create a horizontal or calendar spread. So, the vast majority of the test questions, are going to be vertical or what we call price spreads. But a calendar spread, you should definitely know that if we're going to create a calendar spread, one of the things that should be pretty transparent about that is we're going to need different months, right? So we're certainly going to need different months like January or March, or February and June, whatever the case may be. And the other thing that's going to be different is we're going to have the same strike. Well, not different, will be the same, as we're going to have the same strike prices. So now in the actual Series 7, there are no multiples. There's no multiples or multiples on the actual Series 7. But that being said, there's 8 things you got to be able to do in a spread. You got to be able to identify the spread. That's what this is getting at right here. Can you, determine whether it's debit or credit? Can you determine exercise or expire, widen or narrow, gain, loss, break even, bullish or bearish? Angels weep for you on some of these questions, because some of these questions are just spot on about how things get done. So you should definitely know that the OCC, the Options Clearing Corporation, assigns exercise notices randomly. This question is not about the OCC. It's about the firm. So the firm can assign that exercise notice, as we see here. The firm can do that FIFO, random, or another fair method. You know, LIFO, last in, first out, would not be fair. I mean, if you're the last guy who wrote the contract and you're the first guy who gets exercised, that would not be fair. So I would be prepared. I like Brian's question here, but the one that you should be aware of on the test is accept. They'll say a firm may assign an option exercise notice in all the following ways except. And what you're going to be held accountable for on the test is A, FIFO, yep. B, I apologize, I'm using a Yeti mic, and it's a beautiful day in Las Vegas, and I have the window open on the studio, so perhaps you heard the public school bus come by. Anyways, A, FIFO, B, random, C, another fair method, and D will be something that's not fair. No, LIFO, right? By the way, the firm can't be discriminatory, and whatever you're doing, you have to tell your OCC, and you have to tell your clients, and if you change, you got to tell them too. You can't be making it up on the fly about how you're gonna do things. 8, with XYZ trading, at 47.5, your customer writes a January 50 put and writes at XYZ January 50 call. So as I said, you're either buying volatility or selling volatility. When you're selling volatility, you're neutral. And so this is actually, what I think of, what Dean thinks about is not testable. But here we have different strike prices. This is a short straddle with different strike prices. This is known as a combination. But that's not the point. The point is my market attitude is neutral. PS, you got a problem there because you have a naked call, right? That could be a problem. That 50-45 call could, jam you up pretty good. If an investor buys a January 30 XYZ call for 4 and sells a January 35 call for 2, to become profitable, the spread the difference in the prices. When we're spreading is the difference in the premiums. So let's just put that here. There's a lot of ways to go about it, but again, I like to use a T, and I like to track money in and out. And so I'm going to make a little T here. And let me get this. And it says, okay, we buy the 30 call for 4. So let's put that here. And it says we sell a 35 call for 2. Let's put it here. And again, I like to label things. So that would be dollars out. And this is dollars in. And so it looks like we're going to, if we net those two premiums, we have a debit of 2. I have a debit of 2. Now, I told you there are 8 things you got to know about the spread. I have a whole lecture called Don't Hate the 8. So I have an advanced option strategy, lecture 4 on straddles and puts in the playlist. It's in order. And then I have a separate carve out of that in terms of advanced option strategy. So anyways, what we said you got to be able to do on the test is 8 things. This is one of them. You have to determine whether it's a debit or credit spread. And once you determine that, the next thing you have to be able to do on your exam is determine whether you want the contracts to be exercised or expire. Do you want the difference in the premiums to widen or narrow? Now, the good news about a debit spread, you can remember do, like Nike, just do it, or Mountain Dew, do the do. I think it's the hardest part to get, but what we're referring to is the difference in the premiums, and we need the difference in the premiums to get smaller. When I close it out, that's the hardest part to get. Don't need to get it. So if I go to close this out, right? Boom. Yeah, let me get rid of that. That's not really graceful. Let me use a different one. If I go to close this out, offset, I want those 2 numbers to be larger. That's the hardest part to get. Don't need to get it because debit, exercise, widen goes together. Now, the other thing you got to be able to do on the test as it relates to spreads, we said there's 8 things you got to be able to do on a spread. And besides debit, exercise, widen, you need to know the max gain and the max loss. And I think one of those numbers is pretty transparent. What I mean by that is that when I spend money, I know my loss. So the maximum loss in a debit spread is going to be the net debit. Now, if you don't know that, then you're going to have to memorize, oh my God, that the maximum gain in a debit spread is the difference in the strikes minus the net debit. I just think that's personally a mental mess. But here, the max gain is 5, the difference in the strikes. All the actions between the strikes, there's a 4 and a ceiling there. And so 5, and we add net 2, so the max gain is 3. And then the last thing we got, well, one of the last things we got to do is we got to be able to determine the break even. And so we got a great mnemonic for that as well. And the mnemonic for that is call. And that stands for call, add to the lower. Call, add to the lower. So we're going to take the lower strike, which is 30. We're going to add the net premium, which in this case is 2. And we get our break even of 32. And then the last thing we got to do is determine bullish or bearish. And the way we determine bullish or bearish is the larger premium dominates the position. The larger premium dominates the position. And so the larger premium here is the long call. So this is a bullish spread. And that's important because that means we want the stock to go up from that number. So this is a bullish spread. All right, let's go back to the question of Brian. By the way, I would highly recommend you do exactly what I just did there. Just have a process and go through the entire process before you do anything. Now, Brian's question here was, what do you want the spread to do? And we said it's a debit spread. So in a debit spread, we want exercise widen. We want the difference in the premiums to get larger. So the net is 2. If I can close it out for 4, I'm going to make 2 points, or 5, I'll make my max gain 3 points. All the action takes place between the strikes. P.S. The other thing, the reason I'm doing this is I've lowered my break even, right? My break even, if I just did the 30 call, was 4. So the answer to number 9 is debit spreads must widen. All right, let's clear this up. And let's get our right answer here. Boom. In a volatile market, which of the following option strategies carries the most risk? Wow, I kind of like this one. This is a nice question Brian has for us. You know, in a credit spread, my loss is the difference in the strikes less than net debit. In a long straddle, my maximum loss is the premiums paid. In a debit spread, my maximum loss is what I paid. In a short straddle, I lose money if it goes outside of the break-evens. And how far outside of the break-evens might the stock go? In a straddle, right? In a straddle, a short straddle, I have a short call and a short put, and that short call could blow me up, right? So the one that carries the most risk is that short straddle. By the way, the guy who does the credit spread is a smart guy, right? The whole point of a credit call spread is to buy the higher strike call just in case. An investor with no other position buys a CDE May 65 put at 3.5. If the investor buys the stock and exercises the put, what is the investor's profit or loss? Now, a lot of times too, I'm hoping when you're doing these explications that you're practicing your skills, because what happens a lot of times is people don't know how to proceed. They just keep staring at the thing and not, making a T, not attacking. You got to have some kind of an attack plan. And I told you my attack plan is I like to track money. If you can track money in and out of the account and you're not struggling with contract specifications, you're going to get 100 on options. So, that's what you aspire to. Maybe you're not there yet, but, maybe at some point you will be there. And so, boom. Okay, so an investor with no other positions buys a May 65 put at 3.5. Now, again, I like to do things on a per share basis, but it's up to you how you want to do things. I think Brian would show this to you as $350. I personally like to do things on per share basis. So when I'm all done, I'll multiply. So my point is that your choice mechanically, if you want to put $350 in there, that's fine. That's not what I'm going to do. The other reason I like to do that is because it gets messy if you have 5 or 10 contracts, all the zeros floating around. So, that's just my personal choice. Okay, so it says I buy the stock at 63.5. So that's going to be dollars out. If you buy the stock at 63.5, and it says you exercise your put. Now I like that because remember, one of the things we got to know is what does it mean to say you've exercised your put? And remember, when you have a put, you have a choice to sell at 65. Right? We bought, by the way, one thing I like to do is particularly in puts is I like to above the contract or below, just write somewhere. What am I looking at? I'm not looking at a choice to sell the stock at the strike price. That's what that is in English. And particularly on puts, you might want to do that. That's a choice to sell the stock at the strike price. And so if I sell the stock at the strike price, that's going to be 65. And then what I like to do, again, I personally don't net. I say, okay, well, I'm out 67. I brought in 65. It looks like I have a $200 loss, D. But, some people, again, this is a personal choice, and that's what you're doing the explication. Some people like to just net the columns when they're all done and say, okay, well, that's 65 or 60, or excuse me, 67 or $6,700. That's 65. And so that's what that looks like. In terms of a setup, I'm more interested in the explications, by the way, not so much what is the right answer or wrong answer, is that you get better at your mechanics, perhaps. That's what I'm hoping. Okay, so let me clean that up. And boom. A customer should receive the current options disclosure document. This is, again, very testable. Now, I'm not sure. I've brought this up before in terms of you're going to buy the supplement. One reason I think you might want to consider buying the supplement, the answer here is B, is because if you buy the supplement from Brian, then you get the PDF. And one thing I like to do is just print this out and just turn this into what I call a poor man's flashcard. And then what I like to do the night of or morning of or both is just go through my poor man's flashcards. These would be the PDFs that I've actually marked out the wrong answers and just read the questions and the right answers, the questions and the right answers. Remember, that sequence is very testable. That's the second question Brian has had about that chronological sequence. A customer informs you that news is expected on Data Tech and that she believes will have a big impact on the stock. Unfortunately, she's unsure whether the news is going to be good. Well, so if I thought it was good, I'd buy a call, or will be damaging. And if it was bad, I'd buy a put. As a registered rep, you inform her she could take care of this through, that's why we buy a straddle. There's 4, let me get back to my regular highlighter. There's 4 test questions about straddles, and this is one of them. The first test question is, can you identify a straddle? The second test question is, can you calculate the break-evens? The third test question is, where is it profitable? Where do you need the market price of the stock in relationship to your 2 break-evens? The straddle is the only option strategy where you have 2 break-evens. You have an upside break-even and you have a downside break-even. So, where is it profitable? If it's a short straddle, silo is a great mnemonic for profitability in straddles. And silo stands for short inside, long outside. If we're short the straddle, we want the market price to be in between the new numbers. And if it's long, we want it outside. So here we don't have the premiums, but whatever it is, we'd want it either above the upside break even or below that downside break even. I did a straddle on a company that hired a new CEO, and I thought this new CEO is going to fix their problems. They have major problems, in which case the stock was going up, or he wasn't going to fix their problems, in which case the stock was going down. So not knowing whether he's going to fix the problems or not, I bought both a call and a put. I was out of pocket for both those contracts, 6 points. So I either need 6 points up from the strike. The strike in this case was 50, 56, 44. And to be honest with you, I don't care whether he fixes the problems or not, just as long as the stock moves. Okay. That is my egg timer going off. Woo! That's 30 minutes. So I'm going to turn it back over. And if you want to take a break, I've been trying to make this so if you wanted to, you could. And so if you were interested in your 30-minute, hit the pause button, come back. That would be the time to do so. I'm going to set it for another 30 minutes, and I'm going to continue to march on. So let's see if we can get this thing done in some timely fashion. All right, so your customer is short 100 shares of 65 and simultaneously writes a 60 put at 2. So I don't know if you're going to follow Dean's suggestion, but one thing I told you I like to do is I like to say, okay, what am I looking at? If I write that put, that is an obligation. Let me get a smaller font for that. So here, that is an obligation to buy the stock at 60. So I always, particularly on puts, like to put, above or below the stock. What am I looking at? And that's what I'm looking at there. And I always like to do what's called a setup. And, the setup is based on, again, doing the T. And so, well, I like to make a T. I highly recommend, sometimes I'll be helping people. I'll say, where's your T? They don't have anything going on. You don't have to use a T. There's people who do different options different ways. But you got to have some kind of a process of some sort. And as I told you, what I like to do is put dollars out here and dollars in, particularly when we're looking at puts, because puts can be kind of a mess, right? All right, so now I'm going to track the money. So we're short the stock at 65. So let's put that there. When we short stock, that's going to be money in. Short 100 shares at 65, and then I write the put for 2. That's going to be money in. So I brought in a total of 67. The stock declines to 55, and the put is exercised. The put is exercised. So remember, that's what that means is I have an obligation to buy the stock at 60. That's what that means is say the put was exercised. So again, it looks like I got a problem here. Oh, no, excuse me. I don't have a problem. I got 67 in. I got 60 out. So it looks like I'm a winner. Ooh. So the answer there is I made $1,400, or excuse me, $700. So boom. So here's do a T-chart. I don't particularly like this one here because to be honest with you, I think the more likely test question is understand this as unlimited risk. I mean, this is pretty foolish because you're short the stock and you got a partial hedge by selling the put at 2. But what you really need to protect this is a long call. So I'm not a big fan of this particular question as a test question. I think it would be more likely they would ask you, what is the maximum loss here? And the maximum loss would be unlimited because, 60 or higher, the put expires and you're still hanging in the wind. Customer establishes the following positions. So a customer buys 100 ABC at 28 and buys a ABC December 25 put at 2. And again, I told you what I like to do, what Dean likes to do is not testable. But what I like to do, particularly when I'm looking at puts, is underneath the put, somewhere near the contract, what am I looking at? And what I'm looking at here is a choice to sell the stock at the strike price. And then what I like to do is I like to get my T fired up so I can track money in and out. Now you can simply memorize break-evens if you'd like, but I warn you, if you go down the road of memorizing break-evens, oh my goodness, The stuff that you're going to have to memorize is going to continue to compound. You're going to have more and more stuff that you're trying to memorize. And I like to use out, but some people like to use debit. Some people like to use a minus sign. Some people like to use paid or received. I like to use money out versus money in. However you want to track this money. Anyway, so I bought paid 28 for the stock. I paid 28 for the stock, so let's put that in there. And I paid for the protection. That's what that is, by the way. That's protection. And I paid 2 points for the protection. And so I'm out a total of 30, and 30 is going to be my break even. So this is a one time and the one time only. This is the one time and the one time only that I have a put and I'm not subtracting. So, when you have a stock position, the stock dominates. So, boy, you got to be careful when you're doing your test. Once you see 100 shares there at 28, you got to say, okay, that's what's dominating this position, is owning the stock. And then once I own the stock, I'm either going to be interested in protection, in which case I'm going to buy the option, or income, in which case I'm going to sell the option. What's really cool about this position now is I still have the ability to participate in a big price increase, but not participate in a big price decline. So my break even here is 30. But anytime I want, I can sell the stock at 25. I don't want to do that, but that would be my worst case. I did some construction. My floor is now 25. So the worst case, the most I can lose, not Brian's question here, but the most I can lose is the break even to the strike. XP means strike price. So that's why we do that, protection. An investor is long one OEX. The OEX is the Standard & Poor's. It's an index option. And index options are a little funky. So you are long this, so you paid $1,200. When the current market price is $445. Again, just me in terms of my mechanics, I like to put the 445 above the 420. So the market price is 445 and you exercise the contract. It is very testable to know that index options settle in cash. If when I exercise, somebody had to come up with, 100 shares of 100 stocks, if it's the S&P 100 or the S&P 500, 100 shares of 500 stocks, nobody would play. And so what we agree is you owe me the intrinsic value if I'm the buyer. So what I'm expecting from you is $2,500. Now, Brian didn't ask us about the $2,500. What he's asking you, and what is very testable, is to know that index options settle in cash. And so the answer to 16 is A. If you're taking notes or you got 3x5 cards or 4x6 when you're doing these explications, this is flashcard worthy. Now, the other thing you should know is that index options settle in cash. The cash is the intrinsic value. That's what the person short owes. And that cash is T plus 1. So both the index option contract and the resulting exercise are both T plus 1. Very testable. An investor with no other position buys a 60 call at 3.5. The exercise of the call when the stock's trading at 68 and immediately sells the stock in the market. What is the investor's profit or loss? Well, again, you could just memorize break evens and compare the market price to the break even. But we're trying to practice our skills. And what you're hoping is you can get better at what we call the setup. And so I'm going to do the setup again. And, hopefully you're hitting pause, or maybe you run it back and you go back to this and see, if you can start to get better at doing this kind of a thing. I told you what Dean likes to do is dollars out versus dollars in. And so let's see if we buy the 60 call at 3.5. So again, I think, Brian, if you buy the explication, or excuse me, if you buy his answer game rationale, the PDF, he's probably going to show that to you as 350. I personally like to do things on a point per share basis. So, make sure you don't get too many voices in your head. Everybody does options a little bit differently. I think both Brian and I use T's. I'm pretty sure he does, or I wouldn't have put this up here. So I don't think you're going to be freaked out watching it. All right, so now it says I exercise the call. So as we said, we got to get comfortable with contract specifications. So we should definitely, this is another Dean thing. I use the word choice, but a lot of people use right. It doesn't matter because they're not going to, on the test, say choice or right. They're going to make you figure that out. But that's a choice to buy the stock at the strike price. And so we're hoping they can get better and, options sound less and less like a foreign language rather than more and more. So that means if I exercise that, I'm going to pay 60 for the stock. So I exercise my call contract. The stock is trading at 68 and I sell the stock. So I bought that stock at 60 and it says I sold the stock at 68. And again, what I'm going to do is I'm simply going to net the two columns and say I'm out 63 and a half. And 68 is what I ended up selling the stock for. And so that looks like to me a 4.5 point profit, which in 4.5 points. Now, remember, this is where I told you I like to do it like this, but that's 4.5 times 1 times 100. And so that's going to be $450. $450. All right, so the answer to 17 is B. The answer to 17 is B. Your customer has noticed that her portfolio hasn't been performing well lately. It would like to know how to increase returns. Keyword, increase return. This is very, very testable, very high probability that you're going to see this on the test. And whenever somebody's trying to increase returns, another way you might see this on the test is wants to generate additional income. They're going to do sell covered calls. They're going to sell covered calls. So that is very much a test issue. And so the answer here is right, covered calls. It's a way to supplement dividend income. So the answer to 18 is a C. I think that's a pretty good. By the way, I think increase the return. I think you'll see that expressed on the test as generate additional income. But money out isn't going to do the trick, right? Money out is not going to do the trick. We need money in. And again, we wouldn't write the put because that's an obligation to buy. We don't want to do that. We want to be able to do the offset. What that means is if we own the stock, we want to be able to sell the stock. As an RR, you would recommend a short straddle if you believe the market. Remember, there's 4 test questions on straddles. Can you identify a straddle? Can you calculate the break evens? Can you determine where it's profitable? Silo, short inside, long outside. You don't want volatility. In fact, you're selling volatility. So in a short straddle, you want the market price to stay the same. You want to stay within your 2 break evens. A customer goes long a January 50 put at 5 and writes a January 50 put at 13. So, what I like to do in terms of my mechanics, what I like to do is stack the strikes. So what I like to do is say, okay, I write so on my official Prometric scratch paper, I write 150 put at 13. And then under that, I like to put the other leg, not Tesla, those are called legs. And so the other leg is I'm going long 140 put at 5. And that's how I like to set that up on my official scratch paper. And then I told you, I like to, again, what I like to do is I like to take the contracts and write what I'm looking at. So here, writing a put, I have an obligation Let me get a different color here. To buy the stock. And here I have a choice to sell the stock. And I told you what I like to do in terms of my process is I like to go through whatever it is my process is. And I told you my process is I like to first identify the position. So the first thing I'm going to say, okay, what am I looking at? A straddle, a covered call, you know, a flamingo, a butterfly, a condor. What is this thing? And it looks like to me here, what we got is a spread. A spread is when we're long and short the same type of contract. So this is a spread. The next thing I like to do is determine whether it's a debit or credit spread, because if we get this right, I can rock and roll. If I determine it's debit, I know debit, exercise, widen, and I know my loss. If it's credit, I know credit, expire, narrow, and I've got my gain. So the next thing I like to do is I like to net the premiums. I like to net the premiums. And so that 13 is money in. And that 5 is money out. So that's the next thing I like to do is net those premiums. And so when I net those premiums, so let me get my little boom. It looks like when I net the premium, I'm terrible at arithmetic. I'm not being facetious. So, I might get my calculator every once in a while. If you see something, say something. Every once in a while, I'll do one of these things and somebody call me and say, Dean, 185 plus 9 is not 204. So I'm pretty sure that 13 minus 5, by the way, that's what it's called a spread. We're spreading the difference in the premiums. That's why it's called a spread. We're spreading the difference. It's kind of like the Super Bowl Sunday. I'm coming to you. I'll let you reverse engineer that. So anyways, the Super Bowl, the spread is the bet on the score. Some people want to be outside the spread. Some people want to be inside the spread. Anyways, that looks like to me, that's going to be an 8-point credit. And again, I told you I like to do things on a per share basis, but so that's an 8-point net credit. And once I get credit, I can rock and roll because I know that if it's a credit spread, I want the contracts to expire so I can keep the money neener. I want the difference in the premiums to get smaller. That's the hardest part to get. Don't need to get it. But what we're saying is if I go to offset this thing and I can pay 6, I'll have 2 left over, 5, 3 left over. If I can close it out for a net of 2, I got 6 left over. Hardest part to get, don't need to get it, credit, expire, narrow. Now, we said the gain and the loss always equals the difference in the strikes. And so whenever you sell option contracts, whether you sell a call or sell a put or sell a straddle, or in this case, sell a spread, it's going to be whatever you collected, the net credit here, which is 8 points or $800. Again, Dean does it on a per share basis, but so, in my world, that's going to be 8 points. But remember that in, lingo is going to be 8 points. That's actually $800. So again, you can decide how you want to do things in terms of your options. You got to have a process of some sort. I'll just put that over there. And we said the gain and the loss always equals the difference in the strikes. So let's put that here. So we said all the action takes place between the strikes. All the action is taking place between the strikes. So kind of a test-taking trick. The whole point here is we want to play between 50 and 40, and then we don't want to play no more. And so I just think it's easier to say, okay, well, if there's 8 points to be made or lost, and we just collected 8 of them, right? So whatever these 2 numbers are, let's just put that here. These 2 numbers add up to 10. And so 10 equals 8 plus something, right? So 10 equals 8 plus something. So that something is going to be 2. And so that's going to be our loss. Again, after you get the menu done, you can think about it. I mean, the worst case is somebody sticks it to me at 50 and I stick it to the next guy at 40. I lose 10, I got 8, so I, lose 2. I mean, by the way, that's a pretty good risk reward trade-off. The conversation is not testable. All right, then break even. We're going to either use cal or push. Those are memory aids. Push stands for put subtract from the higher. So to get the break even, we're going to take the higher strike, which in this case is 50. We're going to minus the net premium, which in this case is 8. And we're going to come up with the break even of 42, which is choice C. Oh, excuse me. 40 minus, oh, my bad. Again, pay attention here. So not 40 minus 5. I looked at that. It's going to be right. The higher strike, which in this case is 50, right? Minus the net, which is 8. Minus 8. Yeah, 50, I got it. 50 minus 8, which is 42, right? The last thing we got to be able to do is we've got to be able to determine bullish or bearish. So the last thing we got to do is determine bullish or bearish, And this is a credit put spread. So this is bullish. So ultimately, I want the stock to be up. Boom. Again, I'm doing all the 8 things you're held accountable for on a spread. Can you identify it? Can you do credit or debit, exercise or expire, widen or narrow, max gain, max loss, bullish or bearish, and break even? I did all those things with you. But ultimately here, the difference is 8, 50 minus 8. And so the break even is 42. Let me get my... Okay, we have a great mnemonic too, another memory aid for exporters. Now here, Brian's kind of being a little bit difficult here. And the way he's being difficult is he's saying it's a UK company. It's not a US importer, right? It's a UK company that exports sweaters to the US. So kind of right out of the gate, he's being a little bit of funkiness going on. So a UK company exports sweaters to the US and will be paid in US dollars on delivery to hedge the foreign exchange risk. So what I'm worried about, if I'm selling my products in the US, I'm afraid that the dollar is going to be weak and I'm not going to get as many British pounds. Now, I'm not being facetious. The US dollar is not a foreign currency. And so if I'm saying the dollar is going down, what I'm saying is the British pound is going to go up. And so I'm going to buy British pounds, right? On the test, I think Brian's being a little difficult here. On the test, this would be from the US importer perspective, meaning the person who's importing the sweaters from the UK. But anyways, here he's got it backwards, probably get your attention so that you can do it. But the mnemonic that we have is called EPIC, exporters buy puts, importers buy calls. The opposite is when it's from the other company's perspective. It would be the exact opposite, right? So a person who buys a put will lose all or most of his investments just before expiration if the price of the underlying stock is. So I kind of like this one. I think, by the way, if you're trying to do things in your head, I think that's a bad move. What I mean by that is I would just make up one, and if you make up one, sometimes that becomes easier. So I'm just going to make up a 50 put to illustrate this. So here's my 50 put. Come on. There we go. So that's my strike price on my put. I don't know if it's helpful. What Dean thinks is not testable, but I think of options as being all about floors and ceilings. And, there's a ceiling here at 50. If the stock is 50 or higher, the put's going to expire worthless, right? And so here, Brian is asking us, where are you going to lose all your money? And it looks like if the stock is 50, I just made up the 50, but let's just put that there. Yeah, I mean, if that's the case, I'm going to be in trouble, right? Because that means it has no intrinsic value. And if the stock, I'll just make up numbers 54, that's going to be a problem because it's out of the money. So it looks like to me that 1 is going to be a problem and 2 is going to be a problem. Now, 3 would be that it's got intrinsic value. The stock's down here, it has intrinsic value. So again, I think Brian's kind of being difficult on this one, but I don't have a choice that says 1, 2, and 3. So I got to pick something, right? So, and this one, we're going to say it's a problem if I have the put contract and it's the same, or the stock is going up, because that's not what I want. I want the stock to go down. So that one's going to be 1 and 2. So 22 is going to be D. A customer is long 100 shares at 50. She fears a near-term correction, but overall she remains bullish. As her registered representative, you tell her she'd like to profit. So key word, she would like to profit. So if you're going to profit, you can't be spending additional monies, right? If you're going to profit, you cannot be spending additional monies. You've got to bring some money in. So we should have been able to get this to a 50-50 by saying, okay, if she's going to profit, she's not going to spend additional monies. So we should have been able to get rid of the ones that tell us she's going to, buy something. And she's already bought the stock at 50, so she's interested in the offset. And the offset would be to sell that call. So the answer is C. On January 1st, an investor buys a 1 FLB April 50 call at 4 and an FLB April 50 put at 2.5. If both options expire unexercised, what are the tax consequences? Well, it looks like I bought, let's see, the 50 call at 4. So I lost 400 there, and I bought the 50 put at 2.5. I lost 250 there. And so it looks like I'm a loser. So I'm a loser. The answer to 24 is C. I lost on both those contracts. By the way, that would be a short-term gain. All options trading would be short-term except for a leap. Leap is the only kind of a contract. And to qualify for a long-term capital gain, you have to be at risk for more than 12 months. And the only contract that you can do that is a leap. So Brian didn't ask it here, but for your own edification, that's what that looks like. Again, protection. Whenever we're looking at protection. So if I bought the stock, options about floors and ceilings. For protection, I'm going to buy. And for income, I'm going to sell. If I do a covered call, I'm putting in a ceiling. And when I buy a put, I'm putting in a floor. And, construction costs money, so I'm going to buy a put. And that way I have an ability to participate in a big price increase, but not participate in a big price decrease. I'm not going to get into it. No sense going down some rabbit hole with you. Order equivalence, I'll just comment on this. When Brian and I are explicating exams and doing things, before you think you found a typo, check the video description, because if there is a brain fart, they're real. Brain farts are real. I'll have put in the timestamp where it is Dean did some arithmetic wrong or verbal errata, whatever you want to call that. But you might want to think before you start, is there some other way that, Brian or Dean are doing this? Because I just explicated recently TestGeek exam preps, a Series 7 practice final. And there's a couple questions there where people are, questioning whether Brian got the question right. And he did. And you got to look for nuance. By the way, the other difference in the TestGeek exam prep LLC exams is Brian is trying to have exams that have correlation to the actual exam. I'm not doing that. I'm just trying to help you practice, drill, and rehearse on my content, my exams. So these exams are a little more supposed to be more, Brian's trying to correlate a little more to the actual exam. Anyways, 26. DataTech imports raw material from their Tokyo suppliers. So I'm a U.S. importer. I'm expected to be paid yen in 30 days. So I'm not afraid that my dollars are strong and I end up getting more stuff. That's not going to be the problem. The problem is my dollars are weak and I'm not going to be able to get as much raw material. So again, what I'm afraid of is the yen going up. So, exporters buy calls, exporters buy puts, importers buy call. I'm an importer. So what I'm going to do is buy calls on the yen so that if the yen does go up, I can make up on that contract what I'm going to miss in the exchange rate, right? So if I'm DataTech and I import raw material and I'm going to pay in yen, what I'm afraid is my dollars don't give me as much yen. That means I'm going to get less raw materials. I'm going to, I want to hedge against that. Hedge means offset risk. And so the answer to 26 is A. For the most times, I think Brian had one where he reversed it. For the most part, you can get these strategy questions on foreign currencies using what's called EPIC. And EPIC stands for exporters buy call, exporters buy puts, and importers buy calls. That's what that stands for. Okay, well, let's see. That's we're at it now for an hour. So if you are taking breaks, that's our second hour. I'll reset my timer. Let's see if we can close this thing out in 90 minutes. So again, you don't have to, I think the explication of the Series 7 practice exam, oh my goodness, that thing was 2 hours and 20 minutes. So we have all kinds of lectures for everybody. We got little small ones, we got big ones, we got medium ones. These explications come in a little longer. So we're at an hour right now. I've set it in for another 30 minutes. So let's see if we can finish this thing up in another 30 minutes. But again, you can take your break whenever you'd like, and I will continue to march on. So a customer writes a combination. A combination is a straddle with different strike prices. A straddle with different strike prices. As I said, you're either buying volatility or you're selling volatility. When you're selling volatility, that's a neutral strategy. So if I start with the advantage, if I'm bringing money in, I start with the advantage. Hey, in the comment box, if you have a question you like, you learn something, smash that like button. But tell me, I don't know if you want to watch me on video while we're doing these things or not. I had somebody the other day, your video feed was down. I'm like, I don't know. Anyways, I'm killing the video. And if you have a preference, just let me know. We'll take a poll. Your customer buys 100, buys one ABC November 60 call for 300. So Brian's told you the total premium. So your customer Bob buys a November call for 300 when the market price is 56. Who cares on the exam? It doesn't matter where the thing's at when you do the trade. It matters where it's at when you close the trade. At expiration, now we care. At expiration, it's now 67. So I say, okay, well, if it's a 60 call and the stock's 67, we're going to exercise. If Bob doesn't exercise, we're going to exercise for him because we would assume that's what he wants us to do, but it says he closes his position. So again, what I'm going to do here is fire up my T. Let me get my T out. And we paid 300 for that call. Whoa, I need a smaller font than that. Let's try that again. That looks like a reasonable font size. Okay, at expiration, the stock is 67. He closes his position. So he buys this at a 60 with a market price of 56, at expiration at 67. So we're going to exercise the call, right? 100 shares. Each contract governs 100 shares, right? I'm just seeing if he closes out at intrinsic value. By the way, the math wouldn't be the same. I'm just going to see, we can either close this out at intrinsic value. If we close out at intrinsic value, at expiration, he closes his position. So the position now I can close it out at 700. And that looks like the answer is going to be B, but it would be the same. Let me just show you what it looks like if we exercise the stock. If we close out, that could be we buy the stock at 6,000 and then we sell the stock at 6,700. My saying is it doesn't really matter how you want to do this as long as you can track the money. Either way, it's a $400 gain. So a couple of different ways to look at that. An investor is long a January 40 call and writes a January 50 call. Okay, so a lot of ways again to proceed. I'm going to get out my tool here. I told you what Dean likes to do. What Dean likes to do is untestable, but I told you what I like to do. And what I told you I like to do is say, okay, what am I looking at? That's a choice to buy the stock at 40. And this is an obligation to sell at 50. And we said that lower strike call contracts, always have greater premiums. And that's the one we're going to be buying, right? By the way, a lot of things I can look at too. I could say, okay, well, if these contracts get exercised, I'd be buying the stock at 40 and selling the stock at 50. And that sounds like a great proposition, right? Because I'd make 10 points less whatever these net premiums are. I don't know that. But I have figured out that this one here, just find a different color here. We said this is going to be the dominant leg. Oh, that will always be the case, that the lower strike call is always going to be the dominant leg. And so the one with the greater premium is the dominant leg, and that is a long call. So this is a debit call spread, and debit call spreads are, let me get out are bullish. And it's a debit. By the way, I want these things to exercise. That's what I would want to have happen here. So there's a lot you can do even with the missing premiums. Here I've sold the 50 to lower my out-of-pocket cost on the 40. The conversation isn't testable, but that is a debit call spread. The other way you can do it, and I think I've shared this trick with you. I don't know if Brian shares the trick or not, but I have a trick that I share with people. And another trick, it's just a trick. Don't tell people you're using a trick because, you won't sound as smart, but say, I bet I can tell you whether any spread is bullish or bearish, even if it's missing the premiums. And they're going to say, man, you're a genius. And if you're long the lower strike here is 40. And anytime you're long the lower strike, you are bullish. It's just a trick, but it works every time. So because you are long the lower strike. In any spread, if you are long the lower strike, it is a bullish spread. It doesn't matter whether it's a debit, credit, call, put, does not matter. So the answer to that one is 1 and 3, which is choice A. All right, so let's clear that up. An investor is long a 40 call at 6 and a 50 call at 2, or 600, 200 is what Brian says here. I think that's pretty clever. Let's see if I'm right about his cleverness. Yeah, I don't know if Brian intended this. Knowing Brian, I think he did. But now he's actually given us the premiums to this, right? It looks like to me, oh, it's ABC. My bad. It's not XYZ. It's ABC. But same deal, right? It's the same deal. So again, we said there's 8 things you got to be able to do on a spread. We said those 8 things you got to be able to do on a spread is you have to be able to identify the spread. And so here we've identified the spread, long and short, the same type of contract. Then we want to be able to determine debit or credit. And the way we do that is we net the premiums. Once we get debit, we can rock and roll. We know exercise. We know widen, do the do. So we got to do that. We know our max loss is the net debit. So I net the premiums. What we're spreading is the difference. And the difference there is $400. So my max loss is $400. We know that the gain and loss equals the difference in the strikes. It would be bad form on the test to take any 2 numbers that don't add up to 10. So, don't think about it till after you get the menu done. But once you get the menu done, then you can think about it. If I buy the stock at 40 and I sell the stock at 50, I'd make 10. I spent 4, so I can only make 6. The gain and loss always equals the difference in the strikes. And so here, that's 6 points or $600. And break even is going to be call, add to the lower. We're going to take our lower strike, which is 40, and we're going to add the net premium, which in this case is 4, and we get 44 is our break even. And then we said the last thing we got to be able to do is determine whether bullish or bearish. That's important because we need to know where we want the stock in relationship to this. And we said the option contract with a greater premium dominates the position. And so the dominant leg is this 40 call. By the way, in a call spread, it'll always be that leg. And so I had suggested if you do all 8 of these things, whatever they want to know, you've got the answer to. And so Brian wants to know, do we want the spread to widen? The answer is yes. And we want it to exercise. So it looks like our answer is going to be 1 and 3. Do, Mountain Dew, Nike, just do it. Or when you're wide like Dean, you need to exercise. When you're wide like Dean, you need to exercise. Whoop. Let's see, we said widen. So 1 and 3. Yeah, there we go. That's correct. All right, your customer is long. Your customer is long 1XYZ November 30 call. When she learns that XYZ has announced a 3-for-2 split and wants to know how this will affect her option. As her registered representative, you tell her on the X date she will own. So for an uneven split like this, we do not change the number of contracts. So she had 1 and she's still going to have 1. So that gets us to A or C. So you should know we're not going to change for an odd split the number of contracts. So that means for an odd split, 3-for-2 is odd. It's either going to be A or C. And then what we're going to change is the multiplier. So you don't have to do a bunch of math. I think a lot of test prep providers spend a lot of time making you do math. There's no math necessary to get the right answer on that. I would expect a question on VIX. I would expect a question on VIX. VIX is about volatility. And it's known as the fear index because you can use this fear index to hedge, to do whatever you want to do, but it tracks very much a test question, the S&P 500. Again, if you choose to buy Brian's either the options for $32, which is the carve out of his option tutorial videos, again, I'll put those there, and then you get the PDF, this PDF, and you also get the answer key, and that'll come in at $32, or you can get his entire paid supplement for $80. If you're going to do that, I highly recommend you print out the PDF and then turn questions like this into a poor man's flashcard. And the night before or morning of, just go through and read all your poor man's flashcards. So the answer there is D. 33, an investor is long 100 shares at 50. It establishes a choice to sell at 50. That is known as, so what you're doing there is you are marrying a put to your stock position. You are marrying a put to your stock position. I'm wishing for you a dream draw. Everything you studied, whoa, that's not the one we want. Everything you studied shows up. And you go, man, I don't know what the big deal is. And a lot of test prep providers get in the weeds about your cost base. Cost base is what you spend for the investment. So my cost basis here is going to be the break even. What I paid for the stock, 50, plus what I paid for that protection, 50. That's my cost basis in the stock. So let's just say this was a put and it was 3, it'd be 53. Please note, the only exception to that is if you buy the put after you've established the stock position. Then the tax consequences get a little funky because you've perhaps interrupted the holding period if you had to have for 12 months. More of an issue with your test prep provider than it is on the actual exam. I like number 34. It's testing on do we know what a spread is? What we're spreading, remember, is the difference in the premiums. It's when you're long and short the same type of contract. You're long and short the same type of contract. Maybe we use process of elimination. Process of elimination. No, that is a straddle. Long a call and short a call. That looks pretty good. Long a call and short a call. And I just want to make sure that there's no better answer. There's no trick involved. So I'm going to check the underlying. Nope. This is going to be nothing. That's just the same side of the market. Same side of the market. Yep. By the way, that's a calendar spread, right? That's a calendar spread because what's different is April, May. I told you very much a test question. A fairly conservative investor is seeking income. Seeking income. So you immediately should be able to get rid of this and get rid of this, because if you're seeking income, you got to be bringing money in. You got to be bringing money in. Now we said whenever you hear that seeking income or generate additional income, what you're going to do is a covered call, a covered call. An investor is long one XYZ April 40 call and short one XYZ July 40 call. So here I got the Aprils. This is April, I'm long and I'm short the 40s. And remember, longer term option contracts are always going to have greater premiums. Longer term option contracts are always going to have greater premiums. So you shouldn't be struggling with this as a calendar spread. That you should not have been struggling with, right? Because what's different is the months. Now you got to determine based on that whether or not you're bullish or bearish. And remember, the larger premium dominates the position, and the longer term option contract here is the July 40 call. And remember, the greater premium dominates. And so that means what we're really doing is selling that 40 call. And so the answer is going to be 2 and 3, which is choice C. That was a tough one. That's a tough one. Tough one, longer term option. So that's the dominant leg, the one with the greater premium. An investor writes a call in July, but it expires in January of next year. So when are the tax consequences realized in investments? The tax consequences are realized at the end, right? So it's when the option expires. B, I think that's another good poor man's flashcard. That's a good poor man's flashcard. 38, an investor wishes to generate maximum income for their portfolio. She's currently long 300 shares of M&O at 50 and would like to place an order to sell 5. 5 calls. Well, let's see. I'm just making sure here. She only has 300 shares. That's going to be a problem. There's no such thing as being partially naked. You know, there's no such thing as being partially naked. So, I mean, she's got 2 naked calls there. And, you know, this is called a ratio, right? A ratio, right, is when you write more call contracts than you got stock. Yeah, it looks like she's got a problem there. Mission and Houston, we've got a problem, right? So 38 has unlimited loss potential. Your client bought, this is kind of funky. Your client bought, so remember what this means? Let's say, I think this is worth a little more investment in terms of time here. So you bought the July put, so you did an opening purchase. And so remember, the offset to that is going to be a closing seal. That's how we offset that. So what would you recommend to close? So if we were long, what we're going to do is the offset, the opposite. It's called the offset. And so the answer is we're going to sell, which is a short. I don't particularly care for this as, you know, one of Brian's questions. And I don't hurt his feelings. I don't know if he watches these videos or not. But if, you know, we're me and I'm talking to Brian, I talk to him every now and again. I'll say, hey, why did you change that one? More likely, you're going to just get asked about opening purchase versus closing sale. But, you know, I get what he's getting at. I like the intellectual takeaway. I'm not so sure I really like that question. You have several clients that currently own, let me clean up our. You have several clients that currently own option positions in DXY. The company has declared a 50-cent cash dividend. We do not adjust option contracts for cash dividends. We do not affect them. So, you know, we only do that for other things. So that should be an aim and shoot point and click question for you on your exam. The answer is D. In November, an investor wants to sell his shares now, but he doesn't want to incur the tax consequences until next year. If he is only willing to hold the shares for another 6 months, writing which calls would be the most profitable and achieve his objectives. It's kind of funky. I kind of like this one. So, you know, American style means you can be exercised anytime. European style means you can only be exercised at the end. And so, you know, I don't really care again for how Brian's getting at this, but I do like the test takeaway. It is very testable that American style can be exercised anytime, right? So if I sell these calls and they're American style, I might get exercised before I've met that time frame I'm looking for. But if they're European style, I can only have it happen at the end, which is what I'm trying to do. I want it to happen at a date certain, some future date. Now, the out of the money may or may not get exercised depending on what the stock does, right? So what I'm going to do in 41 is do the either the European April or European January. It looks like I'm going to do the April because that's the one we're trying to get there, right? November wants to sell bears, but next year, so we need to be past next year. And then the other key here is that 6 months. So which of the following would be bearish on the VIX? We said you are going to get a VIX question. We said we are going to get a VIX question, but bearish, really, you don't have to do anything here because, long call, regardless of what the VIX is, if you just thought that was XYZ or BFD, you should have been able to eliminate this and this because those are both bullish transactions. And that's a bullish transaction. So I think I would have got this with process of elimination. And you're going to do the debit put spread, right? A customer is long or buys 100 shares of ABC at 49 and buys a January 50 put at 5. Just prior to expiration with the stock trading at 49, the customer closes the option position at 2. 1 week later, the stock moves to 55, sells the stock. Woo! Listen, when you get a whole paragraph like that thing, I hope that if you only take one thing away from score more 44 or 44 score more, is that, you need to make a T. Somehow you've got to track this money. And so the way I would start here, particularly in something like this, is get my T fired up. Again, a lot of ways to do options. This is money out. This is money in. Okay, so we paid 49 for the stock. That's going to be money out. We bought a 50 put. Again, I always like to, put what we're looking at there. That's a choice. Sell stock at the strike price. XP means strike price. I mean, you can put 50 there, whatever you want to do, particularly on puts. I always like to kind of know what I'm looking at. And that's a choice to sell the stock there. And for that, I paid 5. So that's going to be money out. So it looks like so far I'm out to 54. Just prior to expiration with the stock trading at 49, we closed out the option position. So let's get that there. I did an opening purchase. And so now they're saying I'm going to do my closing sale. And they're saying I'm doing the closing sale for 2. So I'm going to put that in there. 1 week later, the stock moves to 55 and we sell the stock in the open market. So we sell the stock and it says we sell the stock. The stock moves to 55 and we sell the stock. So let's put that in there. And, again, some people like to net columns, whatever you want to do in terms of netting the columns, or you could just do it in your head, however you really want to do it. It looks like if I net, let's just do that. Let's net the columns here because my arithmetic, I told you my arithmetic is really bad. So knowing my arithmetic is bad, I'm saying, you know what, I'm not really going to try and do that, man. I think I'll just put that there. That's 54. And that is 57. And so it looks like we made $300. So the answer 43 is A. I actually think that should be a churning question. I mean, man, my goodness, 4 transactions there, 4 transactions. I kind of like this. What I think Brian was trying to get you tripped up on is, again, the offsets. And I like the offsets. Kaplan has a practice question that I think should be a churning question as well. But I still think it's productive because the guy, buys the stock, he writes a call, he buys a put, the put expires, the call gets exercised. I mean, and if you get good at a T, you can track all that stuff, money in and money out. you end up getting that right. Whoop. That's what I was trying to say. That's the right answer. Oh, man. Come on, we'll change over. I don't know why this thing isn't. Oh, I see. I've got my. I was wondering why my highlighter wasn't working. All right, our last one. Woo, woohoo. An investor would like to take advantage of a rally in an XYZ stock at the lowest possible cost. I like this one. I like this one. So lowest possible cost. So that means I don't want to pay money. I want to bring money in, right? That would be the lowest possible cost. I might have some risk, but excuse me, might have some risk. But so I think the first thing I'm going to do is say, okay, well, I'm going to lowest possible cost. So it looks like what I want to do here is a credit spread that would expire and I could end up keeping the money. So I say, okay, there we go. The credit put spread, right? If I'm right and the stock rallies, the puts will expire and I'll get to keep the money. Neener. P.S. I could just short the put, but then if it blows up, somebody sticks it to me, I can't stick it to the next guy. So the answer to that is D. All right. Well, I hope you found the explication helpful. I don't think I'm going to put this for a Tuesday 3 p.m. upload. That's when we always upload new content to the channel. I think I'm just going to publish it immediately because there's people testing and I don't like doing premieres. We do a chat before that, and this is coming in at just under 90 minutes. So I'm going to go ahead and put it to the channel. I'll probably have the timestamps pending because I go back and I do all those timestamps. So anyways, like, share, subscribe, and let me know. Go to the community page at the channel. Let me know what you want me to do next in terms of explication. I'm taking a poll presently. Okay, bye-bye.